to Vickery Holman's Autumn Market Review. My name is Rebecca Cook. I'm the Head of Valuation and Local Valuer based in our Truro office. Today, I will be joined by a number of my agency colleagues who will be answering your questions on the Southwest property market. Michael Easton, Head of our Hotels and Hospitality Service, will be providing his insights on the hospitality sector. I will then be joined by Joanne High, Head of Agency, Alan Trelaw, also from our Truro office, and Zach Maiden, based in Exeter. Joanne, Alan, and Zach will each be covering the occupational market, including the three main sectors of office, retail, and industrial. Claire Cochrane, who heads our investment service, has recently gone on maternity leave, and so the team will also be covering the investment market, as well as dealing with all investment instructions locally. We also have the pleasure of hearing from Jordan Kennedy, who herself has recently returned from maternity leave and will be talking all things business rates. So, what's happened over the last 6 months? Since our spring market review, a new government has been formed. Whilst there was a small bounce following the election, this quickly petered out as confidence in the market reduced, further impacted by talks around the budget. More on this later. Inflation reduced and interest rates came down, although not as quickly as envisaged. In terms of Vickery Holman, we have continued to grow with 2 new agency assistants. Caris McKellis has joined our Plymouth office, and Charles Harris joined the team in Exeter. I'm also delighted to announce Morwenna Pound recently passed her assessment of professional competence to qualify as a chartered surveyor. Congratulations, Morwenna. Our development and valuation services also have new additions in our Exeter and Bristol office, further enhancing our offering to clients across the region. Our investment to support the next generation of surveyors continues with a total of 13 across our offices and services. In other news, we were thrilled to be awarded Commercial Agency of the Year at the Exeter Property Awards, where Zach Maiden was also personally awarded Property Agent of the Year. This is in addition to the recent recognition we received as Highly Commended Agency Team of the Year at the Southwest Insider Property Awards. Before we move on to the main event, if you have any questions during the presentation, can I please ask you to pop them in the chat box, and we will get to as many as we can after the presentation. Those we can't get to, we will respond to via email. We've also popped a couple of polls on the screen, and we look forward to seeing your responses at the end of the presentations. So without further ado, let's hear from our agents. Mike, can you come? Oh, Mike, welcome to the screen.
Hello, and I just noticed it was missed out of the last slide, but you also were awarded last month at the Property Awards as Emerging Property Person of the Year. I think that's worth of note.
I was, thank you, Mike. Okay, so Mike is going to spend some time updating us on the leisure and hospitality sectors. Mike, what trading conditions have your clients been reporting this year?
Well, I suppose picking up from our last review in spring, sort of straight into the second quarter, it had been quite a difficult winter anyway, and I think that continued in the second quarter of the year. Easter was quite early. The weather was having quite a sort of a big impact on bookings. And, you know, we ran a leisure webinar a couple of months ago. We were having as a guest a general manager of a couple of new branded hotels in the Southwest. And, you know, he was saying, in effect, the weather was dictating his bookings so much that he was having customers that would book on the day, you know, when the sun's shining. And that's a global brand. So, you know, I think when you ripple that down to the regional and the local guys, it sort of shows, I guess, how tough it was. For the pub and the restaurant guys, I think weirdly they'd seen a little bit of improvement because most of them have moved to sort of shorter opening hours, simplified menus. And although whilst it's still tough, you know, they've been working hard at saving costs. So that was sort of second quarter. Third quarter, which basically is sort of hitting into summer, actually, we had a really good bounce back. And in fact, you know, for some, it was a bit of a recoup of what had been, you know, where they were falling behind year on year. But that said, we're into November now. September and October again have been quite wet, so bookings are a bit patchy, and it's all the knock-on really that you get from starts with accommodation and sort of ripples out into the food and drink market. So yeah, I think that's sort of it. We're tending to see the trend, which has been the case for the last couple of years. Budget's doing quite well. People are quite willing to go out, but they want to do it on a budget, and high end is doing quite well. It's still the middle ground that's suffering in the main. I think ultimately there's still quite a lot of caution there, and I feel like a bit of a stuck record because caution sort of stifles people making investments. And the good guys at the moment, whilst they're still sort of headline trading quite well, they're probably thinking more about protection rather than growth. I think it's probably useful to make a comment on the budget right now, and although Jordan's going to pick this up from a business rate point of view, hospitality, third biggest employer in the UK, they're hit quite hard by the changes in last week's budget with the national insurance, particularly the threshold, and then we've got another minimum wage increase coming in next year. It's reported that that's a sort of the effect is about £2,400 per full-time employee for our employers. So it actually does make it difficult to them. It's not that they don't want to pay the money. It's just simply, where are they going to get that money from if it's not coming from headline revenue?
Yeah, so picking up on kind of trading conditions over the year, it's been a mixed bag. How is that reflected in transactions?
I think transactions tend to sort of mirror, what our clients tend to see. It was pretty tough over winter. There was a bit of a slowdown on some transactions because I suppose whatever's happening operationally in our market has a impact on buyer confidence. So there's been more reasons, I suppose, for buyers and operators to sort of sit back and wait rather than commit. Second quarter deal levels were quite low, but the last quarter actually it's been noticeably better. It's good to see some of the larger hotel deals transacting again, seeing a bit more foreign capital come into the market, which I think is helpful and necessary at the moment. But what we're seeing in the main, I suppose, is sales of gone concerns rather than going concerns. And in fact, I've sort of pulled up a couple of examples here where we're talking about sites that were closed. And from a positive point of view, these are sites that are now reopening. We've got a property there. I'll go sort of from top left, I suppose. That's the Clock at Chidiock in Dorset. That closed in December, and we had a sales process come through that reopened in September, so a couple of months ago. The good news on that one, in fact, was that we got some bank funding, and they were first-time operators. They had some associated skills, but they were first time, and they had a very solid business plan. Top right, we've got the Mount Ambrose. That was a site that was closed for 2 years and could quite easily have gone to alternative use, but we had a client who was quite keen to keep it as a community venue. We got an operator in there who's run a site before. He liked that because it was quite small, kept his costs down, and we're sort of seeing a lot of that across the board, where we're seeing the smaller venues probably a little bit easier to work on than the larger ones. It's just staff and utilities, really. Bottom left here, that's Harland Bay. That was the old Harland Inn that was knocked down pre-COVID. That's now a sort of luxury apartment block with all of the ground floor as a bar, restaurant and retail area. That's transacted now, and we look forward to seeing what happens there. They'll reopen as soon as they can. And then finally, down in Lewes in Cornwall, actually, we've got some experienced operators going into the Globe, which is opposite the railway station. But again, it's a reopening. We're sort of fighting against the media sort of take on the fact that pubs are closing, but actually, there are sites opening as well.
I think that's really interesting, and it's great to hear that buyers are investing to reopen the doors of these establishments.
Yeah, definitely.
So finally, Mike, before we let you go, looking ahead, what are your predictions for the sector for the next 6 months?
I think we're similar to last year, actually. We're sort of going to go through a period of make, do and mend. I think that there will be fewer group purchases in the market. I think they want to see, what may play out just with more recent budget changes and, again, how the winter sort of goes. I think if they do want to buy, they'll want to buy well, and that ultimately means that we've got a price adjustment in order to sort of make that happen. Hotels will be interesting. I think the sort of the new build hotel pipeline is pretty much built out. We'll have the opening up at Exeter Science Park and Corbin Head in Paignton. So in effect, we'll have a sort of a slowdown on new rooms, which is probably a bit of a benefit to the existing sites that we have. But yeah, I think it's going to be make to amend. I think it's good to see there's some positivity in the lending sector. But I think everyone's just sort of waiting to see if values will harden again, and that might bring a few more people out to make commitments.
Yeah, great. Thank you, Mike. Certainly a sector to watch over the coming months, and particularly with pending business rates changes.
Yeah, absolutely. And I know Jordan will pick up on that. It's a pivotal part of what I talk to with my clients.
Great, thank you. On that note, welcome, Jordan.
Hello.
Jordan, so prior to the budget, it was suggested we would be seeing huge reforms to the business rate system. What was announced on this last week?
Yes, Rebecca, thank you. You're quite right. That was heavily suggested in the lead up to the election and prior to the budget. So in the manifesto, the Labour Party had stated that the plan was to scrap the business rate system and replace it with a fully costed and fully funded system of business property taxation that would be fit for the 21st century. So that's words taken directly from their manifesto. And they also stated their intention to create a new system which would reduce the burden on high streets. So the budget of last week confirmed that the current system is by no means being scrapped. Far from it, really. So there are some considerable changes being made, but the system as we know it will largely still exist. So under the previous government, there were actually already plans in place which were going to require occupiers to provide information about their properties to the Valuation Office on an annual basis. And this would be either to confirm the current details held on their property or to update the property details with the VOA. This was intended ultimately to potentially pave the way for more frequent revaluations or for a smaller gap between the antecedent valuation date and the start of a rating list. So the gap here is currently 2 years. So the current rating list started on the 1st of April 2023, and that was based on a valuation date of the 1st of April 2021. So there has been much talk about making that gap smaller and also about making revaluations more often than every 3 years. So we had been expecting this requirement to supply information to the VOA to be rolled out between April 2023 and March 2026. So this would have been going on now. And there was also talk of reforms to the check challenge appeal system being implemented from 2026 onwards. However, and quite rightly, I think, it's been realised that implementing these forms will be a very complex and time-consuming process. So there's been further consultation with ratepayers and other stakeholders in the business of business rates. And it has so therefore now been announced that the information duty rollout will actually begin much later, meaning ratepayers will not be required to annually update their property information until the 1st of April 2026 at the very earliest. And this is actually going to be phased in. So to make sure, of course, that the system works as planned. So this will not have been rolled out in full or be mandated until the 1st of April 2029. And it's also been said that the check stage of the check challenge appeal process is going to be removed as a separate stage of the process. And this isn't going to happen until 2029. So really, there are actually no large systematic changes on that front for ratepayers or rating agents to worry about for the time being. However, I do think that this budget has confirmed that it will ultimately be the ratepayers' responsibility to ensure that the information their property valuation is based on is correct. And this can be time-consuming and really quite complex, which is, of course, where we do come in on behalf of many clients. Rating is quite a specialist field, and I do think many ratepayers will find they need professional support with this when the time comes to help with updating their property information, measuring their properties, calculating their floor areas, analysing their accounts, to name just a few of the parts of the equation there. And as it's this information which forms the basis of rateable value, it is really important that this is correct. So moving on to some good news, I think, for the retail, leisure and hospitality sectors. So I've been talking about rateable value. We know that this is combined with a multiplier, which generates a business rates bill. Business rates experts, ratepayers, all stakeholders have for quite a long time been saying that the multipliers used to calculate business rates liabilities are too high. And this is an issue which has finally actually been tackled in the budget, or at least in part. So for retail, leisure and hospitality occupiers, there has been some good news, as the government have said that protecting and supporting high streets is an absolute priority of theirs. And they're seeking to ensure that the business rates burden is permanently rebalanced and that these businesses are permanently protected. Since the COVID-19 pandemic, protection has been in place, but that's been in the form of a 1-year retail, leisure and hospitality relief, which has been being repeatedly rolled over as a temporary measure. Whilst this has been very helpful, it's also caused a great deal of uncertainty for businesses because there's been no real clarity on what would happen to the business rates liability from 1 year to the next, with announcements coming at each budget. So the government now believes it's important to establish permanent sustainable support for these businesses within the system. So it has been announced that there will be permanently lower taxes for these businesses where their rateable values are under £500,000. And this will come in at the next revaluation, so from the 1st of April 2026. The biggest cut is planned for properties currently paying a small business multiplier. So that's those with a rateable value of under 51,000. Those paying the standard multiplier, so that's with a rateable value between 51,000 and 500,000, will also benefit from a permanently lower multiplier, just not as low as those paying the small business multiplier. And as I said, these rates will be set at the next autumn budget, so October 2025, and the new rateable values will be calculated from April 2026. So, of course, this needs to be paid for, and the government have stated their intention to fund this tax cut sustainably by asking those who can pay more to contribute to supporting their local high streets. So the intention is to introduce a higher multiplier for properties with the rateable value over 500,000, and this will capture in the majority large distribution warehouses, particularly those used by online giants, which has been, again, something the industry has been calling for quite some time. So there is going to be a bit of an interim period, though, for those businesses before the multipliers are announced. So from next April, the retail, hospitality and leisure relief is going to be reduced from its current level of 75% to 40%. And again, this will be up to a cash cap of £110,000 per business. So that means that those paying rates using the small business multiplier will see their rates increase by 40% from next April. And those on the standard multiplier will see their rates increase by 40% plus inflation. So there's some good news and bad news in there, which depends on the nature of the business. Good news for the retail, leisure and hospitality sectors, although this will not be felt until 2026. And of course, we don't know the extent of the assistance to these sectors until the multipliers have been announced. And good news in that there is at least a 40% relief continuing rather than no relief whatsoever, which was potentially an option, having the 75% relief removed altogether. However, there's no good news for the office and industrial sectors, where many businesses will face continued increases to the multiplier in line with inflation and will therefore see their bills increase once again from April 2025. So not long at all now. So just to conclude a little bit, I do feel it's positive that reforms to the system have been slowed down to actually ensure that the Valuation Office have the correct infrastructure in place. But I am concerned that we don't seem to be getting any closer to more frequent revaluations or a narrowing of the gap between the valuation date and the start of a new rating list. And I do also worry about the pressure ratepayers will eventually face to ensure their property details are correct. It's good that that's not until 2029, so there's a good few years in the lead up to this being mandated to get the property details correct in readiness. And of course, this is something that we can very much help with where needed.
As you say, Jordan, some positives in there, but less so for the leisure and hospitality sectors in the short term. I'm sure you'll be doing what you can to realise savings for our clients where possible. Jordan, many thanks for the informative update.
Thank you.
Okay, time to welcome our agents. Joe, Alan and Zach, can you please come and join me?
Hi, Rebecca.
Hi, Joe. Hi, Alan.
Hi.
And last but not least, hi, Zach.
Hi.
Welcome, everyone. Okay, so we're going to start by discussing the office market. Alan, can you kick us off with what we're seeing across the sector in Cornwall, please?
Yes, of course, Rebecca. Thanks very much indeed, and hello to everybody. As we've often said, probably the office sector is generally a pretty steady place in Cornwall, rarely grabbing the headlines. But we've been seeing some interesting activity recently, as well as ongoing steady deal making in relation to some of the smaller suites. As we've probably referred to before, the office sector in Truro, or in Cornwall rather, is not so Truro-centric as it once was, and occupiers are now more willing to consider premises in various locations around the county now, which might be better located for the company owners, their staff or clients. Of course, the economics of building new offices are difficult to make stack up. So there's a shortage of good quality accommodation, especially to purchase. And this has recently been borne out with the sale of the former Watson Marlowe offices at Pendennis Court on the Falmouth Business Park, which appear in the middle of the top row there, which we've just completed on. This two-storey building of over 11,000 square foot has sold to an owner-occupier. Haven House in Truro is now under offer as well. This 11,000 square foot landmark building in Truro is generated from interest from developers, occupiers and investors over the period that we've been marketing it. We did have a letting lined up there several months ago, but that fell through and we're now under offer to a buyer. And if all goes to plan, that should be sold by the time we get around to a market review in the spring. And Haven House is there just in the top left-hand corner of the slides. Looking around the county and selling to smaller suites, we continue to see deals being done steadily in relation to some of the new and newer developments where we act. Several of these having been developed by Cornwall Council over the last few years, such as Chai Tevians at Poole, Esam at St Austell, and perhaps the most recent, the Workshed at Liscard. In all these locations, I'm pleased to report there continues to be a steady uptake of units and inquiries, and my colleagues Morwenna and Carris doing a lot of the hard work in these locations. There's an image of the Workshed in Liscard there, just in the top right-hand corner of the row of photographs on the slide.
Great, many thanks, Alan. Jo, can you talk to us about the market in Plymouth?
Yeah, of course. So in Plymouth, we're seeing the majority of demand for sub 1,000 square foot suites. And we've done a number of lettings in this size range recently. A selection is on the slides below. Demands from a mixture of businesses, mainly upsizing due to growth, but also those looking for something better than they currently have, whether that's in terms of the specification of the office, parking availability, location, or a mixture of all three. Serviced offices still seem to be popular in Plymouth, and there are requirements in the market from larger serviced office providers who have Plymouth on their target list. We've spoken about it before, but I think the popularity of serviced offices is due to the flexibility they afford tenants, as well as the add-on benefits some service offices provide. Tenants are looking much more closely at the overall costs of an office now, so the cost of service charge is coming under close scrutiny, especially in buildings whereby the utility costs are charged via the service charge, since these have obviously increased, which has meant some service charges have gone up more than others. And I'm spending quite a bit of time explaining to tenants the differences in service charge budgets to ensure they're comparing like for like.
Thank you, Jo. And how's it looking in Exeter, Zach?
Well, Rebecca, as ever, with the lack of supply of quality offices in the city, it will only take a couple of key requirements to make up the supply versus demand imbalance. We are aware of a handful of serious occupants on the professional side looking to take space at the moment. And although the sentiment is tough, incentive packages are becoming very competitive, which may entice occupiers to actually take action. There's also been a renewed preference for in-town offices, as work-life balance and culture promised by the out-of-town developers has not quite been provided for. What we can say here is that people who are looking are going to do deals. This is genuine demand. There's lack of quality, with poor and basic spec abundant throughout our marketplace. Some quoting rents have actually reduced slightly on some of the best space, which has generated some demand, which is very welcome news, however. This now feels a bit more like a pre-COVID market. The last couple of years have appeared to be fishing expeditions, whilst occupiers consider their options, which we've stated a few times before. However, the serviced office sector seems more active in Plymouth than it is here in Exeter, but it is very encouraging that there seems to be more confidence in our marketplace for people to take traditional office space.
So a mixed picture across the counties. And Zach, what are your predictions for the sector over the next few months?
Well, actually, as I alluded to a second ago, there's quite a few actual requirements in the marketplace as we speak. So actually, we predict a bounce back with a number of good-sized deals transacting from Q1 25 onwards. This is actually a sector that we believe could gain some from growth and Exeter's requirements as Exeter's requirements start to take action. So I think this is quite an interesting sector to for next year to take account.
Great, thank you. Okay, so moving on to the retail sector now. Joe, would you like to start us off with the market in Plymouth?
Yeah, of course. So in Plymouth, we've seen national retailers return to the market with requirements, which has meant there is more competition amongst tenants now. So we're starting to see the balance tilting back towards the landlord. We've recently completed the letting of the former Superdrug in the city centre, and we should have the former William Hill on Cornwall Street under offer shortly. There are requirements in the market for larger spaces, predominantly entertainment-led, but these occupiers, as well as those in the food and beverage sector, are asking for large capital contributions from landlords for fit-outs. The city centre public realm works are pretty much completed on New George Street and Old Town Street now. There's a picture on the bottom right of the slide there. So if you haven't been in to have a look, then you should, because it's looking great. And work has started at the beginning of October on the £30 million Armada Body works, which are being done in phases. We've also seen retailers and to some extent office occupiers reusing existing fit outs and actively seeking out properties that are part or fully fitted to reduce costs, given the rise in construction prices. Finally, on market towns, some of which seem to be getting a hard time in the press recently due to the number of vacant units, we recently put a small unit in Tavistock on the market, which is top right on the slide below. And I was concerned when we put it on that we might struggle to find an occupier given the competition, but actually we ended up with 3 offers within a few weeks of marketing.
Which is great and really interesting to hear the demand for larger retail units. Zach, how are things looking in Exeter?
Well, again, actually, the high street is actually reasonably okay in Exeter, and the recent purchase of Princessade by Frasers Group will be welcomed by the market, ending a level of uncertainty in such a large vacancy in the city centre. Hopefully, there'll be more retail deals transacted due to this change of ownership, but we'll have to watch this space for now. In Exeter, we're actually experiencing reversionary rents, which is quite interesting. We probably hit rock bottom just after COVID, but now rents have been slowly increasing following this bottoming out, which again is very positive for our city. We have noticed that a number of the lifestyle brands, the Edinburgh Woolen Mills, White Stuff, Salt Rocks, etc., appear to be back in the marketplace. Some of these have been through CVAs and now refinanced are coming out with fresh new requirements, which seem to be stimulating activity throughout the region. Therefore, we've actually seen Exeter High Street, the Zone A, go up quite significantly, if you can call it that, about £10 Zone A. So we're now about £125 to £150 Zone A on our high street. This is very encouraging, actually, as we were significantly lower than that over COVID. Exeter Prime and above 100,000 global rent, however, is a bit of a mixed message, unfortunately. Headline rents are still being achieved, but institutional landlords are offering big incentives and capital contributions, as Joe also mentioned in Plymouth. However, once rebased at market rent, we are experiencing good demand for space in the high streets. Lastly, and I've said this before, certain locations like Coastal are still proving high in demand, but really now it's only for the best space, which do go quickly, but secondary has fallen away slightly.
Thank you, Zach. And Alan, how are we looking in Cornwall?
Thanks, Rebecca. Yeah, I'd echo Zach's point there about Coastal and our better regarded market towns remaining in reasonably good demand. In Truro, there has been a number of lettings and relocations over the past 6 to 12 months. So if you haven't walked through Truro for a few months, you'll see some changes taking place on the high street, all of which is encouraging, although in some instances this has left vacancies in more secondary and tertiary locations, which can be difficult to find new occupiers for. Some years ago, we described how the high street in Falmouth had been bucking the trend at the time when there were very few vacancies there, while other towns were suffering. But the retail pitch in Falmouth did look a bit less healthy 12 to 18 months ago. But just like Truro, there've been some deals there which have taken place over the last 6 to 12 months, perhaps making Falmouth look back in pretty good health as well. And we do treat that as a bit of a good barometer of what's happening on the high street. Beyond the high street, and while Morwenna in our Truro office probably deals with more high street retail than me, I seem to be more focused on roadside retail and drive-through type sectors. which remain active, trying to fill gaps where they're not already present, although finding the right location and actually getting deals over the line and into planning can take a long time. That time often down to the planning process. There's an aerial image in the middle of the slides here at the bottom of a plot of land at Helston, which we marketed over the last few months, conjured up good demand from roadside occupiers and developers, and that should have progressed further into a planning application by the spring, all being well. And we're also working on an interesting off-market deal with a roadside food operator somewhere else in Cornwall, which hopefully will come to fruition in the new year.
Brilliant. Okay, thank you. So moving on now to the industrial market. Alan, can you talk to us about what's been happening in the sector across Cornwall?
Yeah, sure, Rebecca. Thank you. In Cornwall, well, we've always talked about industrial being the sort of star performer of the sectors, and it is still a popular place to be, one where there's a limited supply of units of most sizes, leasehold or freehold, and occupiers continue to go towards the best quality space that they can find, but there is a very limited amount of new build. So prices for good quality industrial are probably only going to increase due to the lack of supply. Rentals in many instances are in excess of £10 per square foot these days. And looking back over the past 12 months, we've been involved in a couple of very good off-market industrial deals of a reasonable size, and this trend is likely to continue. There are photos, I think, second and third on the top row of developments at Helston Business Park and Scoria, where we act for the MJL Group. And these locations continue to be a good barometer of the market for us. Demand can probably best be described as steady rather than exceptional. We do have a 4,000 square foot unit at Helston under offer at the moment that maintains the strong rental tone there. Reflecting on the demand for freeholds as well, we've recently exchanged contracts on a detached 8,000 square foot unit at Poole, and a 7,500 square foot freehold premises at Kernick Industrial Estate Penryn is now under offer. One of the off-market transactions we recently completed was the sale of a modern, good quality industrial building at Trelay, near Redruth, where we were able to introduce the buyer and seller to each other and broker a deal which suited both parties. This unit was around 12,000 square foot and sold for an undisclosed price. That's the first property at the top left of the slide.
Thank you. And Joe, Plymouth, please.
Yeah, so much the same story in Plymouth as it is in Cornwall. Been a very limited supply of stock, and rental growth over the last few years has been strong, so rents are now at an all-time high. The rates review has sent RVs up on industrial, so occupiers' overall property costs have increased dramatically, and that's against the backdrop of inflation. This has led to a levelling off of rental growth and people becoming much more cost conscious. There hasn't really been any new supply this year other than a few units here and there. For the larger units, landlords won't commit to building speculatively and do require a pre-let or pre-sale in place. Demand for second-hand units, especially freeholds, has been really good, mainly because they are immediately available and more cost-effective when comparing to new build. We have a unit at Langage, which is on the left of the middle row on the slide, which is under offer. It's just over 15,000 square foot, and we had multiple offers when it came to the market. And it's under offer at over £9.50 a square foot. In my opinion, the differential on a rate per square foot basis between small and large units is now almost non-existent.
I think most would agree, Joe, for the size of the unit, that's a very strong rate per square foot, and perhaps a further highlighting the imbalance between supply and demand. Thank you, Joe. Zach, Exeter.
Well, demand has actually cooled slightly by the sharp rise in rent and capital values over the past few months. Exeter does, however, have a limited amount of space to be developed, so we've always expected rents to be robust. That being said, long gone are the days of purely adding another £1 per square foot onto the next deal, and this is due to the economic uncertainty and a mix of a slowdown in the local market. Let's remember we had market-busting demand and rents over the last few years, so a return to the market norm was inevitable. It's very much still our strongest sector, however. A slower summer period, compounded by the general election and the budget uncertainty, did appear to stifle demand somewhat, whilst previously active buyers and occupiers remain firmly seated on their hands. But we do expect movement in this regard in Q1 2025. There is, however, potential for the market to require some readjustment to facilitate deals as occupiers become more price sensitive. We are optimistically cautious in the industrial market as it remains relatively stable in general.
Thank you all. So moving on now, it's been an interesting period for investment properties. What's currently happening in the market, Jo?
So since our last review in the spring, we've seen inflation drop to 1.7% in September, which was a surprise and is mainly down to lower airfares and petrol prices. The markets are pretty confident of an interest rate drop tomorrow, with expectations for another in December, which could potentially see the year ending on a rate of 4.5%. Since the return from summer, although I hesitate to call it that, we've seen a number of investment properties launched to the market, with more to follow before the end of the year. Demand is good across the board, so long as the pricing is correct. And to give you a bit of a flavour of what we've been doing, let's run through some completed transactions. So starting in Cornwall, Alan.
Thanks, Jo. The first photo, top row left, is part of the industrial estate of Goonhaven in Mid Cornwall, which we marketed earlier in the year. We had competitive interest in this multi-let estate, which proved once again the demand for that sort of stock. We've got a total of 12 units, making up a total floor area of around 18,500 square foot, with a mix of different tenants, so that investors' risk is spread across several different occupiers. We're marketing this off a yield of approximately 7% and achieved a price that reflected a sub 7% yield in the end when that completed. And not one that's completed yet, but I am currently circulating a mid-sized single-let industrial investment in Mid Cornwall to a short list of preferred investors at a yield close to 6%. And it's going to be really interesting to review the interest that we receive for that over the next few weeks to see just how strong the investment market is at the moment. Back to you, Jo.
Yeah, definitely. So on the slide there, middle top row, that's a shop and flat in Birrelstone that we sold earlier in the year. Rent roll was just over 16,000 and we achieved a net initial yield of 8.7%. These smaller lot sizes, let to good local covenants, continue to be popular. And then top right on the slide, we recently sold a parade of 3 shops and 3 flats in Plymouth via auction. Rent roll was just under 37,000 and we achieved a net initial yield of 8.9%. Over to you, Zach.
Yeah, well, thanks, Jo. So probably not aware, we transacted a deal at Sky Park, 2 units together. This was off market, about 4,000 square foot. Rent was it was a staggered rent at on average rent of 37,000 per annum. Price was 550, yield of 6.5% net initial. It's interesting to see that one, quite sharp. Brand new industrial, good occupiers taking space there. And I guess for longevity of a long-term investment, it was a good buy. So that just shows that a smaller lot size was strong, even in quite an uncertain investment market. We also sold, bottom right on the screen there, Rogers Industrial Estate in Paignton. That had a rent roll of 117,400 per annum. Price achieved on this it was 1.7 mil, yield of 6.5% again. It's a multi-let industrial estate, 17,000 square foot. It does show that this type of asset, again, is very much in demand. And although that was a bigger lot size, it was quite a sharp yield and one that we were delighted to acquire for our client.
Perfect, thanks, Zach. So finally, on the investment front, a couple we've recently launched to the market include Poseidon House, which is the Riverview one there on the slides, multi-let office building in Plymouth. Rent roll of just over 172,000 a year, asking price of 1.35 million, which gives a net initial yield just over 12% and a low capital value of £70 per square foot. And I'm pleased to say it has just gone under offer, so fingers crossed for a quick completion. And then we've also launched a multi-let industrial investment in Plymouth at Devonshire Meadows. Rent roll there is 189,000 with an asking price of 2.3 million, which shows a net initial yield 7.7%. So do get in touch if you'd like more information on that or any others we've got coming over the next few weeks.
Great. So I mean, it's fair to say that you all have your hands full, but what else has been keeping you busy over the last few months? And let's bring back Mike as well.
Do I kick off in that case?
Mike, over to you.
Yeah, I think it's just what's been keeping us busy is trying to work with the clients on planning. You know, it's a case of we know our market's quite tough and has been for a little while. And when's the right time? I think there was a question in the group from Tony, B's trainer, about some of the clients wanting to get out before you get the reduction on the reduction for business rates next year. And I think there will be a few that want to come out as soon as they can. But it sort of brings us on to some of the issues with transactions generally, which is they just do take longer than you want them to take, and that's been the case now for the last couple of years. So we've got a few that want to sort of jump this year with a view to being out in time for Easter next year. And in a hospitality sense, that's quite good timing. They take some of the costs in the off season, but it means that they're offering the promise of better times ahead to a buyer, basically. So yeah, that's what's keeping me busy at the minute, is sort of hand-holding advisory, really.
Thank you. And Alan?
Yeah, thanks, Mike. Thanks, Rebecca. I'll pick up from there. We are keeping ourselves busy in a lot of different sectors, in addition to just the straightforward big three that we mentioned before: offices, retail, and industrial. So we're dealing with some interesting development properties, some of which are in the midst of planning at the moment. We've got the care developers and operators LNT, who are midway through a planning application to deliver a new care home on the former Cornwall Council offices at Camborne. That's the top left photo there. We've got interest in the remaining 1.3 acres which adjoin it, which that interest is currently being considered by our clients as well. So that's about 3 acres or so outlined in red there. There is strong care sector interest in a variety of the larger population centres in Cornwall at the moment. So that's an interesting thing that's going on at the moment, and a flavour of the month. Another thing we're dealing with is Luxstowe House at Liscard. Next photo down on the slide, another interesting property that we're handling for Cornwall Council. This is a large property with a mix of Grade 2 listed accommodation towards the front and a more modern extension at the rear. So any sort of repurposing or redevelopment needs some very careful work to achieve that. There's also an aerial photo down at the bottom there of a residential opportunity in Penzance, which should have planning very soon. And this is going to be a great opportunity that we'll be putting around the market for a developer to hopefully progress without too much delay with that planning in place. And potentially that could be into a improving housing market. Let's hope so. There's a high profile one for Zach and his team in Exeter there, which is shortly to be relaunched, Larkbeer House at the top of the right of the slide there. Saying this has been complicated due to recent listing of the gardens and the parkland attached to the property. And this provides something like 17,000 square feet on 4.5 acres, and it's going to be guided at 3.5 million. So a real prominent instruction there for Exeter. The one in Plymouth, we've got 7 trees there, the last photo, which is a former healthcare clinic, now with consent for 10 supported living units, which Joe has under offer. So we hope to see that one over the line soon. So you can see from this sort of wide variety of various properties, we're having a wide selection of residential and other development opportunities across the region.
Great, thank you, Alan. So moving on now, let's talk about the budget. Joe, shall we start with changes to stamp duty land tax?
Yeah, perfect. So the higher rate of stamp duty, which is payable by purchasers of additional dwellings, has been increased from 3% to 5% above the standard residential rates. We've also got the Renters' Rights Bill going through Parliament at the moment, so professional landlords will be feeling the pinch. That may mean more landlords leaving the sector, which will push up rents in already a very tight market.
Yeah, I'll pick up a couple of other things there. Thank you, Joe. Turning to things like inheritance tax. Obviously, we've all heard this anyway, about the 100% relief currently on passing a business or farm to a relative in probate. That's going to change in April 2026, and we're capped the first million. And after the first million, it's capped at only 50% relief. So will people therefore look to sell their business earlier and pay capital gains tax instead? Or will they pass on the business or farm to the next generation a bit earlier and hope they survive for another 7 years? It's early days. We'll have to see where the changes do take place and how people sort themselves out there. And pension funds are now to be included in an estate from April 27. So actually, will people look to withdraw from their pensions a little earlier and make different investment arrangements before April 27? Will they still want to invest via a pension? We'll have to wait and see. We've also seen the changes in capital gains tax, which came in immediately. So the increased tax level isn't something that can be avoided. And of course, a tougher tax regime is going to be with us for the foreseeable future, with a recently elected government, of course, with such a large majority. And the budget promised to fund and simplify, fund the simplification and streamlining of the planning process. And I read that there's funding earmarked to recruit and train several hundred planning officers. So we wait to see how that investment helps. It's definitely a step in the right direction, but it certainly isn't going to fix anything overnight in that side of things.
Well, I guess all I can add in conclusion is we have a direction of travel now for the next 5 years. We can't change it. There will be winners and losers. But having said that, we are in the West Country. Supply is still low here, and hopefully it's keep calm and carry on. I think it's quite positive actually in our side of the world.
Nicely summed up there, Zach, and a positive note to end on. Okay, thank you all. That ends the formal part of our review. Many thanks to our agents, Mike and Jordan, for their updates on the market. At the start of our review, we popped a couple of polls on the screen, the results of which hopefully will be available to view now or shortly. Just looking at the clock, it does look like we've got time for a couple of questions. Let's have a quick look. Joe, we've got a question for you on the Tavistock retail market. Joe, you touched on the property in West Street that has been, sorry, it's jumping me out of the chat box. You touched on the property in West Street that.
Yeah, I
Sorry,
I got it. It does. Me too. I got it. Yes. Yeah. Hi, Jana. Do I have a sense of the feeling of what's happening in Tavistock? I think that shows that there's good demand from occupiers, and actually of the three parties we had interested, real mix of businesses, some new businesses, some expanding businesses already in Tavistock and wanting a bigger premises. So I think that is positive, and yeah, demand is still good for Tavistock.
Thank
I
you,
might
Joe.
pick up on that as well, if that's all right, Rebecca. Just from a hospitality perspective in Tavistock, we dealt with Eastgate Cafe earlier in the year, which was very popular, and we've got some interest, albeit at last, at the Aldall Farms. I think the market towns actually are probably coming back a little bit more likely because we've got more smaller footprints. And we've got more people willing to take a risk on smaller site sizes. So I think Tavi certainly fits into that quite nicely.
Great, thank you both. And Jordan, Tony's asked a question on the business rate system. Is this just for England?
Yes, everything I said does just relate to England only. The document the government published regarding all the changes refers to England. Wales and Scotland have different. Well, it's up to them to govern themselves in relation to business rates. So certainly Wales, I think, already had a lower level of discount this year. For example, they were already at 40%. Anyway, I won't go on too much about the other areas because I specialise in England. But yes, in short, it does just refer to England only.
Great, thank you. I think that's probably covered off all the questions, unless I've missed something.
Oh, we've got one in about news just in. The Trump plans could halve UK growth. Oh, yes. What are our thoughts on that? Oh, sorry, I've opened a can of worms there, haven't I? Gosh, I don't. Yeah, what are our thoughts on that? I mean, there's so many changes, isn't there, across the world? I think everyone's sort of used to that to some extent now, aren't they? And like Zach says, we're down here in the West Country. We're generally sheltered from the worst of most things, aren't we? Our supply is generally still pretty low compared to other places. So I think, it's the keep calm and carry on. I like that.
No, I would tend to agree with that a little bit, but I think whenever you get a significant change, markets, they just don't like it. They stop, but ultimately they do go again. I think we'd all be quite keen to probably get through the next couple of months and let things bed down a little bit. But I would imagine there'll be a bit of caution for a little while.
I think from the polls we can see that one of the polls was about the interest rates. Obviously, we're all very interested to see what happens on Thursday as a continuation of some slight direction downwards of the rate. So that's another major sort of announcement that everybody's been building themselves up to, isn't it? Really?
Yeah, for sure.
Thank you. We've also had another question come in from Tony in the meantime. How might the budget, minimum wage and national insurance changes affect the care sector?
Although we don't deal with that in an agency sense, it sort of probably ticks over to the going concern stuff that I do. And I think the reality, Tony, is it's similar to what I mentioned earlier on. You've got employers that have to find a significant amount of money in order to run their businesses, and that's money they've got to find. So they can only find it from revenue or changes in saving costs in other departments. So it's quite tough. And I think care probably similar to hospitality. There's a larger number of part-time employees. So I mentioned the 2,500 per full-time employee, but ultimately you've got a sort of percentage of that coming through the part-timers as well. So some of them might have to look to whether or not they're going to have more full-time jobs, less part-time jobs, and sort of action that accordingly. But either which way, it's going to be tough, and they've got to push top line and or other costs in order to afford it. I've got an operator at the moment. I think they've got 92 employees, mix of full and part-time, and the difference for them next year is £44,000, which they've got to find from their business. That's just a reflection on what it's going to be like for everybody, really.
Thank you for that, Mike. And Tony, I can ask somebody from our healthcare team to make contact and discuss that with you in more detail. Okay, unless anybody else has anything to add, I believe we've answered all of the questions here today. So on behalf of the team here today, thank you all very much for joining us. And we look forward to seeing you all again in person in the spring. Thank you.
Thanks, everyone.
Thank you.
Thank you.